Okay, hi everyone, welcome to today's webinar. So for today's session, we're going to be talking about the multi-time frame analysis and the trading strategies that you can use for the different time frames. Before we get started, we're just going to give about 2 more minutes to let more people join the session. In the meantime, let me know if you guys can hear me and see me, if my slides are clear and all of that. Feel free to grab yourselves a drink, make yourselves comfortable, and yeah, I'll see you guys in about 2 more minutes. Thanks, everyone. Okay, let's go ahead and get started. So, as per usual, a risk warning and disclaimer, our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. I'm Melanie. I am an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. And here's our agenda for today. So we're going to look at which time frame is the most important, taking a top-down approach, what you should look out for on the higher time frames, zooming into lower time frames, and then we're going to craft our trading strategy. If we have time at the end, we will go through a couple of charts. So feel free to pop any requests into the chat, or if you have any questions throughout the webinar, feel free to pop them into the chat as well. Okay, let's get started. So starting off, support and resistance. This is just some basics and some recap. Support and resistance levels basically refer to prices at which an asset's price tends to stop following, which would be your support, or stop rising, which would be your resistance. So to identify these levels, we use technical analysis tools such as trend lines, moving averages, and chart patterns. Additionally, you can also look at previous highs and lows of the asset, as well as volume data to identify potential levels of support or resistance. And this is what we're going to look at today for a little bit. Just this kind of is the basics of all of the strategies that we're going to be going through. Okay. So in the image that I've included here, you can see we have our swing highs as our resistance and the swing lows as our support. Okay, so let's first look at an incorrect example. Here's an example of insignificant swings, which are bad points to use for your Fibonacci starting at any points, and as well as any resistance or support levels. Okay, the reason being that the price movements here are too small and there are no significant swing highs or swing lows. So here's another example. You can see there aren't really any clear swing highs or lows, and price movement is really small. Here's a correct example. That's a very clear move up and down with obvious peaks and troughs and clear market movements. Okay, so here's another example of significant swings. So I've drawn out the peaks and troughs here so you can see exactly how clear it should be. Okay, so you can use it as a take profit target or stop loss level, but you typically should not use it as an entry if there are no other supporting arguments, such as your Fibonacci or maybe even your pivot points. Yeah, basically other graphical levels to support your analysis. Using a recent swing high or low is a weak level if it is the only level. Okay, so multiple swings. So if at least two swing high and low levels line up nicely, it's a much better level to use as your support or resistance. So we want to try to find areas where these might line up. So it doesn't have to be at the exact level as long as it's an area that is good enough. So it's a good practice to see how far back you can pull your resistance or support lines. So it's okay to cut through small wicks since these are typically areas instead of specific levels. Like you can see in the GIF here, we're cutting through just the small wicks. As long as you're not cutting through too many bodies of candlesticks, that is fine as well. Okay, so let's look at where we can place our starting point now that we know how to identify significant swings and use them as support and resistance levels. Okay, so when picking the starting point of our pivot, which would be our entry, support, resistance levels, these are the rules. Firstly, you want to check if there's a swing high or low, pullback or overlap level to start from. Secondly, you want to go as far back as possible. And lastly, intersecting the wicks is preferred. So you can refer to this image. You can see here, I do cut through the body of one candlestick, so that's fine. And yeah, but what you want to look out for is a very clear cut where it's just the wicks. Something like this is fine as well. It's not really preferred, but it's not exactly wrong. Okay, but what you want to look out for is something like over here. Okay, so picking the starting point. So we have our first red thumb, which we should stay away from. You can see it cuts way too many bodies of candlesticks, so it's way too messy here. Yeah, so you can see where our green thumbs are. That's what we're looking for. So instead of ending it here, or rather starting it here, we would start here instead. Here's another example. This entire area is way too messy because it cuts too many bodies of candlesticks. Okay, so we just want to intersect the wicks and we want to avoid cutting the bodies of candlesticks. Okay, let's look at another example. Sorry about that. I don't know where that sound came from. Okay, so here is an example of a clear market structure. You can see I've drawn out exactly the shape, the price structure. This is what you want to look out for when you are choosing which charts to analyze on. And obviously here is an example of a really unclear market structure. Okay, so this is what you want to avoid. So which time frame is the most important to use? Okay, so this image here is taken on our USD SGD chart, and this is on the M15 view. You can see it's very unclear. Price structure is very messy. But if we look at our H1 view instead, on the same chart, the same USD SGD chart, just change to a H1 view. It's a much clearer view and a much nicer chart to analyze on. So the rule that we typically will live by is at the very basics, clearer the swing low, the clearer the swing high, and the clearer the trend between these 2 points, the more accurate your analysis will be. So the two criterion that you should look out for is firstly a clear swing low or swing high. Secondly, a clear trend between the starting and the ending points. And then your retracements, your Fibonacci levels, or your analysis is likely to be more accurate. Okay? Next is, yeah, so let's look at our intro to multi-time frame analysis. So multi-time frame analysis is basically involves analyzing the market from multiple time frames. So this can help a beginner trader get a better understanding of the market and make more informed trading decisions. So the first step in this strategy is to select your time frame that you want to analyze. So typically traders will choose at least two time frames, such as a short-term time frame, which would be 15 minutes, or a longer-term time frame, which would be about an hour or even the 1 day time frame. So um, the short-term time frame is used to identify the most recent trends and price movements. While the longer time frame is used to identify the overall trend and market direction. Excuse me. Okay, so once the time frames are selected, the trader will then analyze the market from each of these time frames, looking for key support and resistance levels, trends, and patterns. That's why we went through how exactly you should look out for these support and resistance levels at the start of this webinar. So, for example, if the short-term trend is um, bullish and the longer-term trend is also bullish, then we would typically look to buy on any dips or pullbacks in the market. Conversely, of course, if the longer term trend is bearish, the trader might look to sell or short the market. So overall, the multi-time frame analysis can help a beginner trader gain a better understanding of the market and make more informed trading decisions by looking at the bigger picture and analyzing trends and patterns from multiple time frames. So some things to look out for on the higher time frames. Key graphical levels. This basically your horizontal levels, so your support and resistance that we went through at the start. Any trend lines, any trend channels. Next would be any breakouts out of these trends. And any big moving averages. This would include your 50, 100, 200, golden cross or death cross. Your Ichimoku cloud, and any big Fibonacci levels, including your retracements, extensions, and projections. And lastly, your price action. So price action basically refers to the past, present, and the future momentum from the previous bar in order to dictate your strategy. So that's why we're saying especially the prior bar. Okay, so types of trading on the higher time frames. Trend trading involves entering positions in the direction of the dominant trend and holding them until the trend shows signs of reversal. So for these, it often involves the use of technical analysis tools to identify and confirm the trend. So it can be like your indicators or your support and resistance levels or your trend lines, so on and so forth. Swing trading involves entering positions at the swing highs. So it's more on the um, shorter term trading strategy because we're looking at a price swing within a larger trend. That's why we'll trade this on a higher time frame. So traders will aim to take positions at swing highs or swing lows and take profits at the price as the price moves in their favor. So this strategy typically involves holding positions for several days to weeks, taking advantage of price oscillations. Now, breakout trading involves entering positions when the price breaks through key support or resistance levels. Okay, Traders will look for strong momentum and volatility following a breakout and aim to profit from continued price movement in the breakout direction. So this strategy involves a little bit more careful analysis of price patterns and volume to confirm your breakouts. Mean reversion trading, this is based on the idea that prices will tend to revert to their average or equilibrium levels after deviating from them. So, how this works is traders will identify overbought or oversold conditions and then take positions with the expectation that prices will eventually revert. This strategy often involves the use of technical indicators to identify potential reversals as well. Okay, now zooming into the lower time frames, we have scalping, day trading, momentum trading, and news trading. So scalping is a high frequency trading strategy where traders aim to make quick profits from small price changes. So they basically open and close multiple positions within a short period, sometimes within seconds or minutes, capturing small price differentials. Scalpers will often rely on technical analysis indicators such as your moving averages or your oscillators to identify short-term trading opportunities. Day trading involves opening and closing positions within the same trading day without holding positions overnight. So day traders focus more on intraday price movements and will typically make multiple trades throughout the day. They will often aim to take advantage of short-term trends of volatility, again using technical analysis tools or chart patterns, as well as real-time market data for decision making. For momentum trading, this focuses on capturing strong price movements driven by increased buying or selling pressure. So traders will look for assets that exhibit significant price momentum and enter positions in the direction of the prevailing trend. So for this kind of momentum trading, it focuses a lot on or relies a lot on the technical indicators that focus on your momentum. So it can be like your MACD, which is your moving average convergence divergence, as well as your RSI, relative strength index, and maybe even stochastic oscillators. Because these indicators often will identify your momentum opportunities better than other indicators. And lastly is news trading. So this involves taking advantage of significant market moves resulting from news events or economic data releases. So traders closely monitor news announcements and enter positions based on the impact of the news on the market. They aim to capitalize on the price volatility and rapid market reactions that occur immediately following news releases. So it really depends on your own time schedule or your trading schedule and what fits your lifestyle. Okay, any questions so far? Okay, if there are no questions, let's move on to crafting our strategy. Okay. So now that we know how to identify significant swings and use them as support and resistance levels, we also know the different types of time frame strategies. Now we can look at how we can craft our strategy according to the different methods. So firstly, we have scalping. So this uses a shorter time frame, right? It's fast paced, it's exciting, and mind rattling all at once. Shorter time frame periods between the opening and the closing of a trade, but you grab very small amount of pips and risk very small amount of pips. This takes advantage of market volatility and you're able to avoid known unknowns. Locus of control is from 20 pips to 200 pips. And there's new opportunities every time you open the chart. Okay, if we're looking at it on a shorter time frame, your holding time will be from a few seconds to a few hours. Okay, and it would typically be an hour in the morning, an hour in the afternoon, and an hour in the evening. So it's important to have proper risk management so that you don't need to monitor the trades all the way. Okay, so let's look at some scalping strategies now. Okay, first we have the pullback. Okay, we are going to start off with the horizontal pullback, followed by Fibonacci retracement, and then lastly we have the Nike take. Okay, let's start off with horizontal pullback. In this example, we have three swing highs that line up in this resistance area. Price is breaking above the resistance area and we're expecting it to pull back or retrace back to that same area. So that's why we're calling this a pullback strategy. Okay, next we have, so for this example, when price rebounds off of this green area, this is what we call a pullback support level, hence it's becoming green. In this case, which is the opposite, this is a pullback resistance since we're expecting price to reverse or retrace off of that resistance level. Okay, now horizontal pullback and Ichimoku. This is our pullback at the swing low. Price broke out of that support level and is heading towards we're expecting it to retrace back to this same level. Okay, it's also moving below the Ichimoku cloud, so it also supports our analysis. And you can see price reversed off of this level nicely. Okay, and we can see it's also reversing off of the Ichimoku cloud as well. Okay, so next let's look at our Fibonacci retracement strategy. So if you're unfamiliar with Fibonacci, let me just share this website with you guys. Okay, it's completely free, okay? It's just a very simple guide on how to draw your Fibonacci retracements. So if we look at, okay, so it includes Fibonacci retracements, extensions, which we will go through in this webinar as well. But if you're unfamiliar after this webinar, or a bit confused, feel free to check out those videos as well. So it goes through some of the things that we've mentioned in this webinar, but also some others. So some guidelines, how to draw one correctly, how to look out for one, an invalid Fibonacci retracements. Yeah, and we also have the negative levels, which are the expansions, and I'm not going to go into this too much today. Yeah, so feel free to check those out if you're interested. But what I really wanted to mention was the confluence areas, because so something like this. This is basically where we have two or more Fibonacci levels that line up in the same area that you see over here. Reason being is that praise is often attracted to such areas of confluence, but it might not be able to break past it. So we would expect it to be attracted, but we would then expect praise to bounce off of it, like over here. Okay, another example, maybe over here. Okay, we are expecting price to hit this level and then bounce off of it. So yeah, that's some examples on Fibonacci, as well as some trade management tools that you can use as well. So yeah, feel free to check this out. I will go through some of the Fibonacci in this webinar. But yeah, if you're still unfamiliar or you're just a beginner, feel free to check out that website as well. It's just theforexarmy.com. Okay. Okay. Okay, so starting off with Fibonacci retracement, this is what to avoid. So you can see that the Fibonacci retracement trend line cuts through the price structure. So we've drawn out the price structure in the orange line, and it cuts through completely the price structure. So that's what you want to avoid. Instead, what you want to do is follow price structure exactly like over here. And you can see that our 50% lines up with our where price is currently at. So this is an example of combining our Fibonacci retracement with our pullback. In this example, we have a pullback. So we have two swing lows, price breaking below it, and we're expecting price to retrace or pull back to this level. Next, we have another retracement, a Fibonacci retracement, where our 61.8 lines up at the same level, and we have another Fibonacci retracement, 50%, lining up in that same area. So you can see this is our before, okay, and then subsequently price reversed, or it hit our Fibonacci confluence as we expected, and we're expecting it to reverse back down, which it did after that. Reason being, again, because this is a confluence area with two or more Fibonacci, plus we have our pullback. So we're expecting prices to retrace and also be attracted to our Fibonacci confluence area. And then, but we're not expecting it to be able to push past this confluence area. That's why we expect it to reverse. Okay, any questions so far? Okay, all good. Okay, here's another example. In this case, we have retracement, pullback, and Ichimoku. So price is currently moving in this descending trend line. It's also price is approaching our 38.2% Fibonacci retracement. And it's also approaching this descending trend line. So what makes a valid descending trend line is if there are at least 3 touches on it, which we can see here, it doesn't, right? But it is approaching the trend line here. So next, we pull out our stochastic, and you can see price is moving in this, or rather our stochastic is moving in a hidden resistance level. So hidden resistance is basically when we have this horizontal level, but where the levels match up on our price chart, it's actually making a lower low or a higher, yeah, a lower low, a lower high, sorry. Lower high in the sense that it's moving in a descending resistance line. Okay. So again, we're expecting price to test this level based off of our stochastic, also based off the Ichimoku cloud, since it's bouncing off the edge of the cloud, and also because it's in line with our 38.2 retracement. Okay. Okay, now let's move on to our Nike tick strategy. So, for our Nike tick, we are using the levels that are greater than 100%. The positive Fibonacci retracements over here. For the mid-range, that's what we use for our Fibonacci retracements that we just went through. And for the negatives that I'm not going to go into today, those are our expansions. So for our Nike tick strategy, we have you can see the Nike tick being drawn out by our yellow arrows here. So your starting point and our ending point is the head of the V shape. Okay. And your projected level is basically where the tick or the tail of the tick ends, like over here. So your projected level here is 161.8, but it can also be 127.2. And we're expecting a reversal from there. Here's another example from this GIF. So you can only use this if price it's not just a V shape exactly, but only if price has broken out of the 100% retracement. Then you watch out for the reactions of the 127.2 and 161.8. If price breaks out of the 127.2, then you have confirmation that price is likely to reverse off of the 161.8, like you see over here. So the clearer the movement of the Nike tick, like if you can draw it out like this, then the more accurate your analysis will be. Okay, so for your Nike tick strategy, this is what we kind of the guidelines that we go by. It's not super strict. Again, apply it according to your charts. But yeah, this is just a basic guideline. So your time frames that we use this on the shorter side, your M30, H1, and H4. Entry criteria would be your 127.2%. Okay, and your stop loss 145%. Ideal validation will be at your 138%, break even 11% of the recent move. 50% take profit or your partial take profit will be 11% of the recent move, and full take profit will be 22% of the recent move. Bonus if you can get those levels or your Nike tick levels to line up with any Fibonacci retracement, expansions, projections, as well as any pullback or overlap support or resistance levels. Okay, so here's a long example. Over here is a short example. So we have the 127.2 lining up with a 100% Fibonacci projection, and you can see price reversed off of it nicely. If we go and look at a long example, we're expecting prices to reverse off of this confluence area, where the 127.2 lines up with your 61.8. So we're going in for a buy from this level all the way upwards. Okay, that's it for my slides. We still have some time left, so I'm going to pull out my charts and we can take a look and see if we can apply a little bit of what we've learned through this webinar. Okay, do you guys have any requests for any charts that you want me to go through? Okay, if not, um, maybe I'll just quickly go through Let's see. Okay, let's maybe take a look at euro dollar. So on our weekly time frame, I'd like to start off on our higher time frames and then work our way down so that we have an idea of where prices are generally headed towards. So, or just the direction of trend. So you can see on our euro over the past few years, it's been moving downwards. On our daily time frame, it's pretty bearish as well, especially in recent times. Okay, we have prices moving um, in this descending trend channel. Okay. And next for our time frame, again pretty bearish. Okay, but that's so if I'm trying to decide between the 4 hours and 1 hour time frames, if I'm scalping, okay, we typically will avoid anything less than 30 minutes because it tends to get a little bit too messy um with price changing and yeah. So minimally we'll go to 30 minutes if you're scalping. So how to choose between your 4 hours and 1 hour, basically you just decide which has a clearer structure. Again, it's quite subjective, so it's up to you which is clearer. I think to me, the 4 hours over here is a little bit clearer. So I'm gonna go in with my horizontal levels now. Okay, so I'm gonna place my first resistance all the way here. And like we went through earlier, I want to pull it back as far as I can without cutting too many bodies of candlesticks. So I think this is fine. Oh, let's see if we have any trend lines or trend channels. Okay, we have price moving in this descending trend line as well. Okay, next we go in with our pivot and okay, I think I'll place it like this. So we have a swing high here and we have price testing that level currently. Okay, and then this is my support. Okay, so an example of the Nike tick method that we did earlier. Let's see if we have this Nike tick shape. So let me draw it a little bit nicer. Okay, so let's see if we have a Nike tick over here or Fibonacci extension. Okay, so you can see my 145 or actually my 161.8 lines up since we take into account the wick as well. Okay, we take into account the wick. Yeah, so my 161 lines up nicely, so I'm just gonna keep that. Okay, next we're gonna use a retracement from this area to here, and we're only gonna look at the medium or the mid-range levels. You can see that my 20 okay, price has already broken this 38.2, but you can see my 78.6 lines up with my first support. Okay, and now I'm gonna go in with another projection. Okay, no. Okay, my 61.8 lines up nicely with my pivot. Okay, so you can already see that we have this confluence area here. Okay, and this is the Nike level that we were talking about earlier. So you can see once price hit it, that we would expect it to drop, especially since if I replay this, especially since it's in line with this descending trend line. So we have a descending trend line, firstly. Secondly, we have this 161.8. Thirdly, we have a resistance level over here. Okay, we have a pretty significant resistance level because of all the swing highs and swing lows that respect that area. So we're likely to expect price to reverse off of that area as well. Okay, you can see that's exactly what happened. Okay, now let's take a look at some indicators. I'm going to look at Ichimoku and MACD. Okay, price is moving above our Ichimoku cloud. MACD is giving us a bearish signal. So I'm going to look at maybe stochastic. Okay, so stochastic has what we call a hidden resistance, like what we went through earlier. So this hidden resistance, right? Price is testing. Okay, let me just highlight the peaks. So price was making higher highs. Okay. But over here, it was just maintaining at this level. So that's why we're expecting price to continue to drop. And it did drop over here. Okay. So let's see if it will rise back up and okay, actually let's look at the levels on our trend line. Okay, so we can probably expect the same thing to happen here as well, since price has already touched all parts of the trend line when it's touching our hidden resistance. Okay, so I'm going to remove our MACD because it doesn't support our analysis. Okay. Are there any questions? So if you want another example of a Nike tick, you can maybe look at over here. So the Nike tick that I'm drawing is inverted over here. Okay, but you can see it's testing this 161.8 over here. Okay, so the Nike tick here is quite it's an inverted Nike tick. So earlier we did this one, which is upright like this, and then this one that we're looking at is upside down like that. But both are valid. Okay. Yeah, let me know if you guys have any other questions. Okay, if not, I think that's all I have for you guys for today. Thank you guys so much for joining me. Hope you guys found this session helpful. Have a great rest of your week, and I'll see you guys again next week. Thanks, everyone. Bye.